Okay, welcome to video 23C. If there is a video that's the meat of this module, it's this one. So this is on allocation and apportionment. So let's remind ourselves of where we are, right? So we're through the federal calculation, what states is nexus, how much do they get to tax is the base. Now let's go about calculating the right amount of taxable income. Okay, so when we left off, we knew there were two methods by which to do this: direct allocation and through apportionment. So let's figure out what the differences are between those two. So non-business income is typically allocated. That means it's directly allocated to a certain state, whereas business income is apportioned. And apportionment, as we're going to see, is this artificial system by which the states have more or less agreed, and they used to agree almost in entirety, but now they kind of agree at least in part about the methodology, that this is a decent way to divide up income. The Supreme Court has decided it's absolutely constitutional and it doesn't interfere with the Commerce Clause. And so we have this artificial apportionment system that we use for business income. So, of course, states define what is business income and what is non-business income. And the way that's typically done is they define non-business and then say everything else is simply business income. So when we think about what is typically non-business, and again, these are state-by-state rules you got to look at, and I'm not going to ask you to ever do that. I'm going to more or less give you the guidelines by which to follow. But know that in real practice, you have to go examine what every state does. So generally speaking, rents and royalties from real property or tangible property. So if you're in the leasing business, often that's considered non-business, unless that is your business, the leasing business. Capital gains, interest, dividends, and royalties. These are typically things that you think about as being non-business income in most states. So how are those items allocated then, right? If we decide they're going to be given directly to a state, to what state do they go? So when it comes to rents, typically that's the state in which the property is located. And so the California rule, for example, says if the property is in California, then the income belongs to California. Or if the property is in a non-taxing state, and the corporation is domiciled, which means headquartered in California, then California picks up that income. From capital gains, that's typically the state of commercial domicile. Again, in California, if the property's in California, then California. If it's in a non-taxable state and that corporation is domiciled in California, then it's California. Interest and dividends follow the state of commercial domicile. So commercial domicile is a term that does not equate to where you are incorporated. It really is where is your central management. So we typically think about that as where your headquarters are. So interest and dividends, no matter where they're sourced from, are typically going to go to your state of commercial domicile or where you're headquartered. And then intangible rents and royalties are where the state in which the property is generally used. Okay, so what is allocable in our example? Let's go back to Company Z. Well, remember we had some interest income, we had some rental income, and we had interest expense. So when we think about what is allocable, the next step is we're going to adjust our state tax base. And you're going to see why that's true, because what we're going to do is we're going to take the total state tax base. We're going to get rid of the items that are allocable, because we know what those are. And what are we then left with? Well, we're left with business income, which we're then going to apportion. Okay, so here we are pulling out the allocable income. So anything that was included, so for example, let's look at State A. We included the rental income in State A. Well, rental income is generally allocated to the state in which it's located. So we're going to get that out of State A. There's the negative 200. There's really nothing else that was allocated in the State A, so there's nothing else to pull out. Then when we look at State B, we pull the same rental income out, but we also pull out that interest income, because that interest income is going to follow commercial domicile. It's therefore allocated, so we're going to get it out of our state base so we can get down to our total here at the bottom, which is apportionable or business income. Okay, now that we're down to business income, we got to figure out how to apportion it. So each state develops its own apportionment system, and you can go to this website that I've posted here to see how all the different states use apportionment. But there's an old standard, and the standard was in place for years and years and years, and it was called three-factor apportionment. And if you recall, the three things that triggered nexus were income, property, and employees. And if you look at three-factor apportionment, it depended on sales, property, and payroll. So you can see that what we're doing is we're trying to divide up income based on some artificial measure of economic activity. And the way we're going to measure that activity is based on sales, property, and payroll. Now, there are 22 states that now use a single sales factor. So they apportion income based solely on what sales are. There are 14 states that double weight or triple weight the sales factor, and California is a single sales factor state, but we're going to cover all three factors because there's still plenty of states that use all three factors. Okay, so how do you do apportionment? Well, first you calculate each factor. So let's say, what is the sales factor? Well, you measure sales into that state, and you divide that by sales everywhere. That's the pro rata share of sales into that state. Then you do the property factor. What is the amount of property in that state divided by property everywhere? Then you calculate the payroll factor. What is your amount of payroll in that state divided by payroll everywhere? There's your artificial measures of economic activity. So if you're using the traditional three-weighted apportionment factor, you'd add those three factors together and divide by 3. If you're using a double-weighted sales factor, then you'd double weight sales, so add it twice, then divide by 4, where single-weighted sales just says, look, I'm going to rely totally on the ratio I calculated in number 1. And again, these factors should sound familiar because they are closely related to the way nexus is generally defined. Okay, so let's go through kind of the typical details of the calculation of each of these factors. So even though it's called the sales factor, it's really the gross receipts factor. So you take gross receipts from in-state sales and you divide it by total gross receipts. So we think of gross receipts as being all gross receipts from transactions and activities in the normal course of business. So that can, of course, be your gross sales, any fees and commissions received for the performance of services, any rents and lease payments received from renting real or tangible property, as long as that is business income in that state. And then here's one that's often goes back and forth, right? So the proceeds from the disposition of other tangible and intangible assets. So some states include the proceeds and some states include only the gain loss amount. And again, that all depends on whether that's a business income item or not. If it's allocated to non-business, then we do not consider it as part of our factors. The payroll factor is in-state compensation divided by total compensation. And compensation is pretty much all compensation. So wages, salaries, commissions, and pretty much any other form of compensation paid to employees. It does not include amounts paid to independent contractors, even though recall that independent contractors can trigger nexus. Some states will exclude officers' compensation from payroll. But the trickier part is when you get employees who work in multiple states, like consultants do, and you actually have to distribute their wages across different states because they don't work in a single state. Okay, the property factor tends to be the cost of that property. So not the net book value, not the basis, not the tax basis, but rather its cost. And again, you take in-state divided by total. Generally, that's all the property that is used in the business, right? So again, non-business property is excluded. Intangible property is not usually included in the property factor. And it's almost always valued at its average cost. So you take beginning of year cost, end of year cost, and average those two to get the average property factor for the year. Now, years and years ago, companies thought they might be able to escape paying income tax by converting from ownership of property into leasing that property. And so the rules are generally built in most states to just take the average annual rent and multiply it by 8. So that's just, think of that as a proxy for what the value of that property must be, is rent times 8. And why 8? Who knows? Could have been 7, could have been 9, but it seems like most states ended up settling on 8. And so 8 is kind of the standard these days. And again, note that generally speaking, it's the gross value, it's the cost. It is not after accumulated depreciation. Although there are some states that do in fact use net book value. Okay, let's do an example. MIC generates $100,000 of apportionable income and has the following apportionment of sales, payroll, and property. So you can see here that MIC must have nexus in 1, 2, 3, 4, 5 states. New York, Illinois, California, Texas, and Florida. They have sales, payroll, and property in all of those states. And we've allocated those out, and we can add them up to get the totals. And what we're going to do is calculate how much of their $100,000 of apportionable income, and we're assuming that's the state tax base for New York, is apportionable to New York. Because again, New York doesn't get the entire state tax base, and they don't even get all the apportionable income. They only get their share. Okay, so we calculate the sales factor first. So what are sales in New York divided by sales total? The payroll factor, what is payroll in New York divided by payroll total? And finally, what is the property factor? Property in New York, which these must already be the average cost values, divided by total property. I take those three factors, I add them together and divide by 3, and I get 0.5607, which means 56.07% of the 100,000 belongs to New York. New York's taxable income, $56,070. That's really all there is to apportionment. Let's do New York as a double-weighted sales factor, again, just as part of our example. And we're going to do that because notice that MIC had a large proportion of payroll and property in New York State. So 400 out of the 550 of the payrolls in New York and 100 of the 180 of the property is in New York. So it sounds like this MIC has a lot of activity going on, a lot of economic activity going on in New York. So let's calculate the sales factor, 300 divided by 750. This time we're going to multiply that by 2 because it's double weighted. Payroll factor is the same. Property factor is the same. We add those up and now divide by 4 because we double weighted sales. And we get 52,100. So you can see that as a result of double weighting sales, what happens is we have lowered the amount of taxable income in New York because we're ignoring that payroll and property activity. So a single sales factor is like taking that double weighting to the nth degree. So what happens is you could say, well, why don't we triple weight sales? Why don't we quadruple weight sales? Why don't we distuple weight sales? I made that word up, but it sounds like a good one, right? So ultimately, if you say, well, look, what I really only care about is the sales factor, then I can calculate it based on only the sales factor, and I get a $40,000 income apportioned to New York. And so you can see that using a single sales factor is intended to favor companies that have a large in-state presence because it's diminishing the value of that in-state presence in their apportionment, and it's actually spreading it more broadly across all states. Now, again, if all the sales are concentrated in a particular state, you don't really pick up much there. Okay. So some states don't have a corporate income tax. And in the good old days, that went untaxed. But many states today have instituted what they call the throwback rule, where sales, and only the sales, are thrown back to the state in which they originated. Now, this does not affect the payroll and property factors. So let's assume for a second that at MIC, all the sales originate in New York. Okay, but we're using a destination-based measure of sales, and so we've been measuring it based on the destination, and 50,000 of those sales go to Texas, and let's assume Texas has no corporate income tax. So as a result, we would throw those sales back to New York if we assume New York has a throwback rule. So now the sales factor numerator is increased by 50,000 instead of 300,000, just New York. It's 350,000, which is New York plus Texas. Again, we double weight that. Payroll is the same. Property is the same. Divide by 4. We get 55.4 $55,400. So double weighting, or sorry, the throwback rule has a tendency to increase the income tax in the state in which sales originate. Okay, now if we go back to Company Z, we can actually do our apportionment. We have our state apportionable income calculated. So we simply need apportionment data. So I've given you some apportionment data that I just made up. And you can see that I have sales, payroll, and property. And let's assume that both state A and B are three-factor apportionment states. So I calculate in-state A over total for sales, property, payroll. I calculate in-state B over total for sales, property, and payroll. I add them up, divide by 3, and I get two three-factor apportionment formulas, 0.786 and 0.213. Now I can use those factors to apply against my apportionable income, and that's going to give me my apportioned income. So notice that I apply the apportionment factor to state A, I get apportioned income of $3,301. I apply it to state B, I get $916, which means my total apportioned income is $4,217, and that doesn't tie to anything, and that's okay. That's simply the way it works. Now, you might think you're done, but you're not. Remember that we used the state base and then we deducted out all the allocated income so we could get to business income. Now we actually need to take the step of adding back that allocable income to the state in which it belongs. So we had two forms of allocable income. We had the municipal bond interest, which again, recall those were bonds that were from state A. So state A exempts its own bonds. State A is also the commercial domicile for the corporation. So as a result, the municipal interest is allocated to state A. It's not taxed in state A, and so it's never part of taxable income. It's not allocated to state B, which it would have been taxed had it been so, but it doesn't matter because it's not there. The rental income is allocated to the state in which the property is located. The rental income is located in state A, so that income is allocated only to state A. Now I've calculated state taxable income for both states. I can simply multiply by whatever the state tax rate is to get state income tax liability. All right, here's a process from the book that explains what we just went through. Hopefully it helps a little bit, because that brings us to the end of video 23C. Thanks for watching.